Hi guys, welcome back. MSCI Inc. is the provider of the famous MSCI World Index amongst many others. With their well-known indices and analytic solutions, they offer a range of products that are designed to make investing as easy and informed as possible for both private and professional investors. And what really stands out to me as a dividend growth investor is that they could grow their dividends by over 20% per year for the last 5 years, which is a remarkable dividend growth. So in this video, I will have a look at the business of MSCI, analyze their financials, and will check if they can keep up this insane dividend growth also for the next years. I am Florian, thank you for joining me today. And I'm sorry if my voice sounds a bit off today. I was flying around Europe on a business trip with a cold last week, which wasn't too great for my throat. Over the last year, MSCI has underperformed the S&P by a bit with 2.4% total returns versus the 9.9% of the S&P. But over the last decade, this looks completely different. Here, MSCI could easily beat the index with 960% total returns versus the 230% of the S&P. But here, we also see that the company had its highest value in 2021 and mostly went sideways since then. But there were still some good buying opportunities in the meanwhile, and since their lows in 2022, the company is up again by almost 50%. And as Peter Lynch said, in order to determine if a company is a good investment, we first need to understand their business. So let's do exactly this. MSCI Inc. is the mother of the famous MSCI indices that are widely used for passive investing in ETFs or for benchmarking. The most famous of their products is the MSCI World Index, but they are also providers of different analytics tools and services to help investors, private as well as institutional ones, to make the right decisions. This includes ESG and climate ratings and risk assessments, factor modeling, stress testing, and special analytics for private equity. With these products, they earn a mostly subscription-based revenue stream and can deliver very high margins and a strong free cash flow. So their products can help investors over the whole investment process with data and research-driven insights, starting from the portfolio constructions over choosing the right strategy and asset allocation up until the benchmarking and risk assessment of the portfolio. Their business is split into 4 major segments. The by far biggest segment is their indexing segment, which generates 57% of their revenue. This is followed by their analytics segment with 23% and their ESG and climate segment with 11%. The remaining 9% of their revenue are generated with their private assets and real estate segment that provides data and benchmarks for private equity, infrastructure and real estate investments. What I like a lot about this business is that 97% of these revenues are recurring revenues, either through a subscription or asset-based fees, which are fees tied to the asset under management AUM in investment products like ETFs or index funds that are based on MSCI's indexes. As the AUM in these products grows, MSCI earns higher fees without doing anything other than to provide the index in the first place. This also means that the company is one of the biggest beneficiaries when it comes to the trend to passive investment, but we'll have a closer look at the market later in the video. The company is operating on a global scale. 46% of their revenue are generated in the Americas, 38% in EMEA, and 16% in APAC. On the far right side, we can also see who their major clients are. And all of these clients are professional investors, with their biggest customer group being asset managers. But it also includes, for example, banks, hedge funds, or consultants. When we drill down into the segments a bit and look at the individual year-over-year growth, we see that the quickest growing segment last year was their ESG and climate segment that could grow by 12%, of which 9% were organic growth. Even the biggest segment, the index segment, could grow by 8% last year. And what I find even more impressive is that the MSCI indexes combined could grow their assets under management, so basically the money that is invested with these indexes, by 18% per year since 2008. And there has actually only been 1 year during this time in 2013 where people actually took out more money out of these indices than they put in. We can see this in the graph in the smaller yellow bars that show the cash flow into or out of these indices. And this is purely the money people invested into these indices without taking the appreciation into account. One reason for this growth is that MSCI is constantly evolving and expanding their index offerings. For example, just in the last quarter, they launched the MSCI China Local Equity Factor Model and the MSCI Global 500 North America Selection Index. And they also introduced several new other insights and analytic tools and dashboards to help asset owners, traders or hedge funds to better manage their portfolios or track the trading performance in real time. This has also helped them to secure a couple of new strategic deals with a large European bank, an American hedge fund, and many smaller asset managers, brokers or market makers. So with an investment in MSCI, you are betting heavily on the trend to passive investing and the whole money managing industry, so to say. Since 2014, the share of these passive investment vehicles has doubled from around 25% to even more than 50% of the whole mutual fund and ETF market. And this was even though the money that was put into active funds was also still growing steadily, but with a much slower growth compared to passive vehicles, as this graph shows. The gap between active and passive investing has widened considerably and is also expected to grow further in the next few years. So they are operating in a quickly growing market and they have an excellent position here. Even though the competitive rivalry between a few big players like S&P Global and FTSE is quite high, MSCI has some unique offerings, especially in their ESG and climate segment. There are also high barriers to enter this market, and with their size and reputation, they are one of just a couple of key players here, which gives them quite a moat. And compared to their competitors, they are also more globally diversified, which for me makes them especially interesting right now. So they got a lot going for them. But does this also show in their financials? To make it short, yes it does. The financials of them do look very nice. We have a nice and steady uptrend in basically all metrics on a quarterly basis. This is exactly the picture I like to see for my investments. A predictable and steady growing business. When we zoom out on a yearly basis, we also see a similar trend. A nice and steady growth over many years. Only the net income and EPS have a small decline in 2024 compared to 2023. There are two reasons for this. First, both of these metrics had quite a jump from 2022 to 2023, mostly due to one-time tax effects and the lack of a major acquisition. And second, both the operating and the R&D expenses did go up significantly in 2024 compared to the years before. Since the beginning in 2023, the operating expenses increased by 20% and the R&D expenses by 50% even. I am not 100% sure what the exact reason for this is, but I would guess that it is related to development of AI products that started roughly at the same time. Over the last 5 years, this resulted in an annual revenue growth of almost 13%, a free cash flow growth of 16.3%, and an EPS growth of also 16.3%. So over the last 5 years, they could grow with nice double-digit growth rates all across the board. But what is not so nice is how they grew their stock-based compensation. While the overall level is still under 10% of the company's free cash flow, which I find okay, this percentage did grow quite significantly in the last 2 years. So this is a bit of a worrying trend that I would keep my eyes on, but at the moment it is still not too bad. What looks great again are the margins of the company. They could grow their EBITDA margin, net income margin and return of invested capital steadily over the last years to the pretty impressive figures that they have today. Right now they have an EBITDA margin of very impressive 61%, a net margin of 39%, and return of invested capital of 29.3%. And the balance sheet of the company is also pretty okay. And even though they do have quite some debt from mostly past acquisitions, their net debt to EBITDA level is with 2.4 times, still well below my threshold of 3 times. And we also see that they are lowering it constantly. Well, at least until the next acquisition target comes swimming by. And they are also buying back shares regularly and have decreased their outstanding shares by an average of 1.6% each year for the last 5 years. What I also want to mention briefly is that the goodwill of the company has doubled in the last 10 years. This is not a great trend, but it is roughly in line with the overall asset growth. The ratio between assets and goodwill has not changed very much though, so I am not overly concerned by it, especially as MSCI has good cash flows and an otherwise good balance sheet. But of course, it still brings some risk like potential write-downs, so we shouldn't ignore it. The company is a dividend payer with a yield of 1.3%, but you guys know that I'm always looking for a high dividend growth. So what really gets me excited is the huge yearly dividend growth that averages to over 20% per year for the last 5 years. And despite this insane dividend growth, the cash flow payout ratio is still at only 35%. So if you would have invested in the company 5 years ago, this investment would have a dividend yield of 3.2% today. And if we go back even a bit more and assume that we have invested 10 years ago, we would now rake in even more than 12% of personal dividend yield or yield on cost on that investment. This is the perfect example why I love dividend growers so much. After just 10 years of holding this position or a position in any similar dividend grower, we get back more than 1/10 of our investments in dividends every year. And this is without ever touching the stock again. But of course, MSCI is quite an extreme example here. But the principle also applies for all dividend growers, even if the growth is not quite 20% per year. But of course, this is also the past. So what is the expectation for MSCI for the next couple of years? The 14 analysts that give a 1-year price target for the company see an average upside of 70.7% for the stock. Their EPS and revenue is also expected to further grow, EPS by around 12% per year until 2028 and the revenue by 8.6%. For both metrics, this is around 4% lower than what we had over the last 5 years, so it should slow down a bit, but it is still a very decent growth. Now, the question is if they can keep up this insane dividend growth for the next couple of years. And I would honestly assume that they would have to lower the dividend at least a little bit in the next years so that their payout ratio doesn't get out of control. But even if we only assume a dividend growth of 10 or 15% per year, it would still be a nice growth and way above the inflation. Or I would at least hope that. But this growth also comes at a cost, because their valuation is all but cheap. They currently have a forward PE ratio of 33.5, an EV to EBITDA of 25.8, a price to cash flow of 29.4 and a PEG ratio of 3. These valuations are all roughly 3 times higher than the sector median, but still not as crazy as some other valuations that we have seen recently. And in fact, if we compare this valuation to their own 5-year history, it is rather cheap actually, and roughly 20 to 25% below their 5-year averages. So quality does come at a cost, and at least in the last 5 years, there were barely any chances to invest in them at cheaper valuations. Before I sum this up and come to my conclusion, let's also compare them to some of their closest competitors, including one company that I am already invested in. And if you find this video helpful and want to support the channel, please hit the like and the subscribe button. As a small channel, this really helps me out a lot, so thank you very much. For today's peer comparison, I choose Nasdaq, not the index but the company, Coinbase, Deutsche Börse, Moody's and S&P Global. Because of the diverse nature of MSCI's business, it is a bit tough to compare them one-to-one. But I think that these are some of the companies that give a decent intersection of the general sector. And if you are not following my portfolio updates, first of all, you should. And second of all, the company that I am invested in from this bunch is S&P Global, by the way. And over the last 10 years, MSCI had by far the best performance of this bunch with 959% total returns. Over the last 5 years, this competition is much closer for most peers except Coinbase. Here, Deutsche Börse and Nasdaq could catch the lead, although only in the last couple of months. But all of these companies are fairly close together with performances between 150% and 200%. So most of these have also outperformed the S&P that could also deliver around 150% during this time. Dividend-wise, MSCI, Nasdaq and Deutsche Börse are paying a dividend of around 1.3%, while Moody's and S&P Global only have a yield of roughly 0.8%. Dividend growth-wise, MSCI could easily catch the crown with double the growth of the next 2 contestants, Moody's and S&P. But of course, this strong performance hasn't gone unnoticed, and MSCI also has the highest valuation right now. This comes with the high growth that we have seen already, but in this group, they were still beaten in 3-year revenue and EBITDA growth from Deutsche Börse and S&P, while Coinbase could also still outgrow them, at least in the very short term. The 3-year free cash flow growth from S&P and Nasdaq were also higher than MSCI's, but MSCI could still grow the EPS the quickest. So all in all, I find that they are one of the strongest and quickest growing companies here. With the ESG and climate segment, they might not look the sexiest in the current political environment, but I still believe that in the long run, these topics will become increasingly important. And of course, in the short run, they will keep benefiting hugely from the trend to passive investment. What could also help them in the short run is their larger exposure to international markets compared to most of their US peers. The valuation is currently also well below the 5-year averages, so if you find this segment interesting, I think that now is a great time to start a position and benefit from the huge dividend growth for years to come. But this is just my opinion. What do you think about the company and the sector? I would be really interested to read your thoughts down in the comments below. And guys, if you are looking for an unknown consumer staples company that is also growing the dividends like crazy while expanding rapidly, I have exactly the right video for you right here. And this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.